we're broke. Our debt and deficit is huge. Here in California, we are running a $60 billion deficit. That's a yearly deficit, So, and then we got fires compound on top of that, and there's just so much waste and fraud and abuse everywhere. And I think at some point, like an audit of what goes on is okay to talk about without scaring people and saying mass deportations.
Get ready for a new episode of KP Talks Dollars and Cents. Learn financial literacy and get real-time updates on all things housing, finance, and real estate. So let's get started. Here's your host, Kevin Perenio.
Hey, it's KP coming to you live from Corona, California. 3 videos in one tonight. I've been away a long time. Thank you for being patient. I have so many little notes and like little tidbits that I wrote down. So let's get cracking. I'll try and knock this out quick. Famous last words. Let's have a little reset of everything that's going on to bring us to this point. Remember, we talk a lot about the flow of money here and how it impacts interest rates, our industry, stocks, bonds. I'm not a financial advisor. I'm not responsible for your losses, only your profits. We talk about monetary policy, which is really put forth by the Fed, the biggest driver of buying and selling money in the U.S. and the world. Fiscal policy, what's going to happen next month when we're trying to pass a continuing resolution or a budget. Will it be, a budget and a tax cut in one big, beautiful bill? Or will it be one like the Senate proposes where they just want to do, the continuing resolution and then tax cuts maybe later this year, which then would put GSE release from conservatorship even after that. All this stuff is intertwined. But let me just say this. I believe we're 5 weeks into the new presidency. This is the 5th week, something like that. So there's been a lot to get us to this point. It's so funny. Like LinkedIn is kind of turning into Facebook, where you have like kind of people that troll from, one side or the other, and they just take little, bumper sticker shots at what's going on. And to be fair, like in their defense, it's hard to write everything out in a response to someone on a LinkedIn post. And so it's just kind of funny. Like, anyway, I digress. I'm so glad. I just, after the 2016 election, I vowed not to get into things that are emotionally draining. And so I hope you do as well. Remember that Zen moment from my video? If you didn't see it, check out the one from Deer Valley. It was pretty cool. Okay, so there's a compounding effect of all this stuff to bring us to this point. Okay, and so are we likely to go into a recession? We might. We could have slowing growth or less growth. We've had as high as 4% GDP in a quarter, and now we've been under 3% or at 3%. And last year, before the election, again, I'm not trying to say one thing. I'm just talking about things that take time to compound. The Fed has been saying at every dot plot, every other meeting, they put the summary of economic projections. They've been saying we're going to have like 2.3% GDP this year. Okay. That's not 4%. That's slowing growth. 2% is kind of like on par. 2.3. The average for the year is like, it's okay. It's growth. It's not a strong economy. So we have a weakening economy. We don't have a weak economy, but we are weakening. And these compounding effects take time. So we're going to get a GDP read this week. It's one of the biggest news pieces to come out on Thursday. We have the Fed's preferred measure of inflation, the PCE, the personal consumption expenditure, comes out on Friday. Remember, it's an index, so it's 12 monthly readings. So January of last year is getting thrown out for January of this year. And, we could actually see the headline and the core number come down just a little bit. Let's call it. I love the MBS Highway team. Barry put out today, which, by the way, congratulations, Dan, on little Hudson Grand. Dan Habib had a baby boy, his first, carrying on the Habib legacy and dynasty. Love it. And so Barry was there today talking about, headline PCE could be 2.5, core could be 2.7. And those are both lower numbers than the prior month for a year-over-year reading. But then we've got some tough comps coming up. So, inflation reared its ugly head on the CPI. We know the owner's equivalent rent and shelter costs are still the major part of it in the CPI. But the PCE is a little bit different, less weighting on housing. and certainly on auto insurance and auto leases and stockbroker fees and all that kind of stuff that the CPI had. So it's a big number. Now, in the stock market, remember I already gave my disclaimer earlier, tomorrow's a big day for Super Microcomputer, which is like the server rack cooling supplier for all these NVIDIA servers and chips that are going on around the world. And they had this accounting scandal, and they have to show their audited financials, I think from 2023 tomorrow, or they get delisted from the NASDAQ. I mean, the stock was like a few $100s, and it could go to 10 tomorrow. You know, it's been hovering between 50 or 60, and it could rip to 100 tomorrow or the next day. And then NVIDIA, which is really the last big major earnings report for this earnings season, which is earnings going through the end of last year, they report at the end of the day on Wednesday. And it is like, you know, the biggest, you know, one ever. You know, all the Mag 7s are done except, I mean, there's some other earnings reports that are certainly meaningful. Why do earnings of stock companies matter for our business? Walmart last week, you know, some of these comments are just hilarious. Like, you know, our stock market was touching and setting all-time highs, depending on which indice you look at, S&Ps, NASDAQ, whatever, last week. And then Walmart came out, which, you know, half their revenue comes from grocery sales. People are trading down and buying groceries from Walmart instead of maybe Whole Foods or whatever. And Walmart is seen as a bellwether for the consumer, and our GDP is 70% consumer spending driven. So when Walmart says, hey, you know, we missed our earnings, revenue was good, but our earnings are a little less than we expected, and we see some headwinds coming forward, stock market took a pause. So that was on top of a retail sales report, which was a big miss. And these are all things that are happening from 2024 and earlier. And so I just wanted to remind some people who love to do their little jabs and barbs at, you know, every little daily move and mechanism, that we've had years of certain things happening. Since 2008, the Fed has really driven the bus. I mean, when they went to zero interest rate policies, and we went to modern monetary theory, you know, after the global financial crisis, you know, 2008, which was the Obama 8-year period era, the Fed has been the main driver. And so there are a lot of things that have compounded. And the Treasury Secretary works together with the Fed to try and sell treasuries to fund our government. We've been spending a lot of money. Like the last 4 years, we have piled up trillions and trillions of dollars. Really, since Clinton was in office, we've run a deficit. So look, every president is to blame, but some have more blame than others. If you like blaming presidents, if you're one of those people. But the bottom line is, like, some of this stuff comes to a head, and it may come to a head right here in this president's presidency, because you know that Microsoft and Johnson & Johnson have a higher credit rating than the United States government. And that could get worse if they get downgraded again because we spend too much money and drive inflation. And so, you know, people want to talk about like tariffs and mass deportations and Doge and da-da-da-da. We've been spending trillions and trillions and trillions and trillions and $36 trillion in federal debt on a $29 trillion a year GDP. So the path is unsustainable. It's been unsustainable. It's been compounding for years. And so, you know, we had an inverted yield curve, which uninverted, you know, late last year in December. And, you know, we've had the SOM rule triggered where the unemployment rate within a 6-month period or 3 to 6 month period went up more than half a point. I mean, there's all these triggers that have said a recession is coming. So we know it's coming at some point. Will it be mild? We've been in a recession in housing. We've been in a manufacturing recession, although manufacturing is starting to pick up. And so there are a lot of data points that are compounding. I'll give you some. By the way, negativity always sells when things are going wrong. So don't click on the clickbait. Did you know the U.S. has been the #1 economy in the world since 1890? And we still are, and we're going to be for quite some time. Germany is like 3rd in the world, and they just had some elections, and things are going to change. And, you know, it's very interesting to see the way the U.S. deals with Europe or Ukraine or Mexico or Canada or China. And from what I can garner, I'm not inside, you know, President Trump's head, but, you know, he is saying, look, if we give you something, we want something in return. And that's it. The one-way street is over. I'm okay with that. Michael Zervos, head strategist of Jefferies Investment, chief investment strategy officer, said LFG, less federal government. And so, 20,000 jobs have been so far put on the chopping block, unfortunately, in DC. But I mean, is there? And I'm not commenting on when and where and why, but does anyone think our federal government isn't bloated? Look at the debt and deficit every year. I mean, there's definitely bloat in there. So, we audit our business in July of 22 when things went to hell in a handbasket in our business. We went through 252 vendor contracts and we looked at every single one of them with a fine-tooth comb. Do we need this? Do we need that? Can we reduce that? Can we eliminate that? Why would we not do that with our money? It's your money, unless you don't pay taxes. Which, by the way, the biggest corporate taxpayer is Berkshire Hathaway. You want a lesson on business and life, read 94-year-old Warren Buffett's letter, his open letter to his shareholders. Amazing to read. They are responsible for over 5% of all the corporate tax burden in America. One company, they pay their taxes. They don't skirt taxes. So what else has been compounding all these years to lead up to this point that actually matters in all of our little debates and comments that we write in here and throw little barbs around? Well, we know that new rents have been going down for about the last year and a half. We know that. Will that eventually show up inside inflation reports? I'm sure it will. OER has been slowing. It's still, the shelter components in the OER are still above 4%, but it's down from 9%. Remember how we've been talking about credit card debt and defaults being up from consumers? That's been compounding since all the stimulus checks ran out after, we were, by the way, defrauded like crazy to the tune of billions of dollars. I mean, I want to get into all the billions of dollars being defrauded. I mean, literally, there's so much fraud out there. I can't even. Anyway, but the consumer being extended and running up all of their credit card debt to max limits and defaulting, that's been happening for years. And that will hurt the consumer and eventually have them pull back, which is why it's meaningful when Walmart says at the end of 2024, they're noticing some headwinds coming forward from the consumer. So those are things that have been compounding for years. Like some of these media outlets, even in our own industry, read about it. Like, have been writing that. But then they want to say that everything is Trump's fault. It's unbelievable. I'm not trying to defend Trump. I'm just saying, there is a lot of blame to go around, but there's a lot of data that's been compounding for years to get us to this point. So just kind of recap about it. I keep seeing people type mass deportations. So pretty much every president has had deportations. The deporter-in-chief was President Obama for 8 years at 3.2 million. And in Obama's first administration, there was 1 million illegal immigrants deported. I don't know how many are going to get done right now. As I've said on many of my other videos, I am so happy that the Chilean gang cartels who are raiding my neighbors' houses and are in my neighborhood, I'm glad they're being rounded up and sent home. And I don't want people to be separated from their families and all that kind of stuff. And we need our workers. You guys know I have a construction business, flip houses on the side. I don't want that to be harmed for me personally, but from a bleeding heart standpoint, I don't want to see families ripped apart. So just when you see people write mass deportations, it's just scare tactics. Did you know that since 2020, over 90% of all new jobs created in America have gone to immigrants? Now, some are illegal. So 4.7 million new jobs since 2020 have gone to immigrants, and only 645,000 new jobs have gone to native-born Americans. I'm not a xenophobe. I don't, go get it. If the job's there, if you're an immigrant, you could get a job. And I'm not saying get rid of them, get our jobs back. I'm not trying to do that kind of thing. But, we're broke. Our debt and deficit is huge. Here in California, we are running a $60 billion deficit. That's a yearly deficit, So, and then we got fires compound on top of that. And there's just so much waste and fraud and abuse everywhere. And I think at some point, an audit of, what goes on is okay to talk about without scaring people and saying mass deportations. Venture capital money, way down. We're the country of innovation that the rest of the world looks at, and it's way down. That's not a good thing. But year to date, 21 asset classes are up, all 21. 10 Tech is still good. Obviously, it's a deflationary tactic, to make productivity huge, which is increasing, which is good. Our demographics are amazing in this country, and that will continue to be amazing. I would love to see the 2 wars that have been started the last couple of years to go away so we can have a peace dividend in the world. I hope it works. And we'll have a new Fed chair at the end of January 26th. So I could go on and on and on, but there's just so much that's been going on for years to get us to this point. Don't let anyone tell you different. But we can only control what we control. Hope you have a wonderful week. It is spring purchase season. LFG, less federal government.
Hey, it's KP coming to you live from Corona, California. Well, I just recorded a 15-minute video and the sound was awful. So here we are again. It's after 7, so it's not too late, but I do have a buddy waiting for me to have dinner. And I'm going to do part 2 of all these compounding effect things. And I'm going to pray that when I stop recording that it's all working. I'm also going to say, hold your children tight to me. We had a colleague lose a young daughter, and it is life is precious. So we're going to start right there, and hopefully we all feel very blessed about the things that matter, not the 10-year Treasury or rates or who the president is or whatever the policies are. Like this is chill, and let's put some perspective. So let's talk about some more framework around where we are, and I want to talk about kind of debunk or at least kind of pivot off of bond traders are the smartest guys on Wall Street, or girls. They are smart because they hedge risk and manage risk. They're not smart because they can predict the future. So since the Fed's first rate cut of 50 basis points in September, and then of course they did 100 basis points total of cuts, the 10-year Treasury has ran, and it's kind of coming back down. And so it brought a lot of uncertainty in September. Like, okay, is this going to reignite inflation? Is this too much too fast? We didn't expect this coming. Now there's an election. Who's going to be president? Okay, now we have the president. What are they going to do? Okay, there's tariffs. There's deportations. How's that going to impact everything? Plus, we've had some data points come out that, could spook you one way or the other. And so think of institutional traders, they're, calm seas never made a skilled sailor, right? So when the first Fed rate cut came out, they pulled up their anchor and they went to a calm report, all right? And there are at least less rough waters. And so now that we see the 10-year Treasury coming down, I mean, it's down. Rates are the lowest they've been in 2 months. Lowest they've been in 2 months. Let's go. Come on, Longhorns. They'll beat Arkansas. Get off the bubble. So they are slowly dropping their anchor. And we're seeing that with the 10-year Treasury yield come down. Rates are much better now than they were even 5 weeks ago. So we saw 480 10-year, we got down to like 427 today. Now, the data ebbs out, right? And so that data that's coming out is what gives that confidence to continue to buy more treasuries. But there's more than just the data. And so I want to talk about that. So the U.S. Treasury Secretary, Scott Bessent, who used to be on that side, on that bond trading side, now he's in charge of Treasury and working with the Fed to try and fund our lives, our government, where we pay our taxes, and they spend it so wisely. But, he basically said last week, we don't want the Fed that's doing quantitative tightening. Okay, they're letting treasuries run off into the market. We don't want them competing with the treasuries that we need to sell to fund our government. And so that was very well taken. And a couple weeks ago on the quarterly refunding announcement, they said, we don't want to sell a bunch of long bonds, 30-year bonds and 20-year bonds. We want to, buy some of the stuff that's, shorter term, because let's say they buy a 3-year note or a 5-year or a 7-year note, 3-year, I think it's 3-year bill. Bills are short term, and then notes. So bills are 2 and under. Notes are 3 to 10, and then the long bond is the 20 and the 30. I had to get that right, and I might be wrong. So that was seen as favorable. They're going to be smart in the way that they are going to sell treasuries, and they didn't really raise the amount of how much they're going to sell. And they said for several quarters ahead, we're not going to raise the amount that they're going to sell. The bond market likes that. Anchor just continually, slowly dropping on all those little things. And here we are. We're having great lock days. We had some great lock days with these rates coming down. And so the Fed is watching. Obviously, they're watching labor and inflation. We got 1.87 million job openings out there. We have a 7.5% U6 unemployment rate. That's anyone looking for jobs, even though the unemployment rate, I think it's the U3 number, the regular one we see on the first Friday of every month, it's at 3%. Inflation, yeah, it ticked up a little bit on the CPI, but last month there was a really high number of auto insurance, auto leases, and car sales that came out in the January CPI. But the index for February, the Manheim index, shows that used car sales are actually ticking down. So that could be seen as a one-off. That could be seen as a favorable future read for CPI. But the one inflation read that matters is this Friday, the Fed deflator, their preferred gauge of inflation, the personal consumption expenditure. Headline number is supposed to be 2.5. Core, stripping out food and energy, could be 2.6 or 2.7. So we'll see where it goes. But what the Fed is also watching is the 2-year Treasury. And this is a very important thing that I don't think gets talked a lot about in our industry. Hats off to Logan Motoshami. You know, he takes questions on Instagram, and he did. I shot him one. I'm like, can you do like a channel breakdown for the 2-year Treasury? And he did, and he does such a masterful job of that. The 2-year Treasury, even though it's not an overnight rate, it's known as market rates. And it's kind of the telltale sign of where we think the economy is going in the short term. Are we going into a recession? Are we going to see growth? We're getting Q4 second read of GDP tomorrow, so that's a big deal too, in addition to jobless claims. The Fed funds rate is at 425 to 450. So let's call it in that range, right? Currently, without any more cuts. That's 4.375, 4 3/8 for those of us that look at rate sheet. Some people will say 4.38 because they round it up to just 2 digits. The 2-year Treasury has come down and it's at 4.08. I'm just checking right now on the MBS highway. And so if the Fed does another quarter basis point cut, that range goes from 425 to 4, which means 4 1/8, 4.125. The 2-year Treasury today is below that. And so there's now room for the Fed to cut, and they will still be above market rates. That's what they want to be. I don't know what everyone's reading, but if you go to the CME tool, which is the Fed Funds Future Watch tool, they're pricing in a quarter rate cut in June. So I hear some people, remember earlier this year, they're like, they're going to raise again. And then it was like, okay, they're not going to do any cuts this year. And now people are starting to go, maybe there's one. Oh, maybe there's 1.5. You know, if the economy slows and job growth, continues to soften, especially if we get, some more confident data, I would say, in the numbers, and then we're accurate. And, you could see the Treasury yields and that curve continue to come down. And that's good for mortgage interest rates. So we're only in, it's been 5 weeks since, the middle of January, when we saw like a 480, I think, on a 10-year, and now we're down to like 427. So on the 10 years, that's good. I mean, it's good. Celebrate it, y'all. Celebrate lower rates and wonder why. We have, 10% of Americans make up like, $1.3 trillion in savings in 50% of all the spending in America. The bottom 90% of income earners have exhausted their savings. And there's credit card debt, credit default stuff. It's rising. And that has a compounding effect on economic spending and GDP and consumer spending and consumer confidence. Now, the Economic Consumer Board confidence was a little weak this week. Don't pay too much attention to the University of Michigan sentiment because it's very divided by political ideology, right? Like if you're a Democrat, you think we're going to have, 5% inflation. And if you're extreme right, you think we're going to have no inflation. So, and that number is an average of the two in the survey. And so but the Economic Consumer Board, these confidence numbers are showing us something. People are a little uneasy. And I'm not going to talk about tariffs. I'll wait till Friday before I start triggering anybody. But right now, we have like 2.3% tariffs on our $3 trillion of goods are imported. So we don't have a lot of tariffs right now. We do have tariffs. We've always had tariffs. Tariffs were not inflationary. The first Trump presidency, ultimately. There was fear of it, but it ultimately, and this time around, it's not to start a trade war, it's to end the fentanyl and drug war. And I don't know, it's only been 5-6 weeks. I don't know the update or any data that said fentanyl's not coming in as much. I'm sure we'll start to see that coming up. But you know what really matters for inflation? It's our budget and our fiscal policy. So not so much the monetary policy from the Fed, but the fiscal policy. March 14th, we expire our current continuing resolution. We have no budget. So the House has passed a budget, which is Trump's wishes, which is the big, beautiful bill, which is both an extension of his tax cut and a budget. The Senate wants to take a two-step process. They have passed only a budget, and then they'll work later on the tax cut extension, maybe. And there's razor-thin margin in both the House and the Senate. So what's interesting is that the Senate path is the one we end up going down. GSC release out of conservatorship could take even longer and kick down the road if we had to do this in a two-part dance. In the will of the people and power and the 90-day mandate the president has for winning the election in a landslide electorally, and of course by popular vote, that starts to wane over time. So we're going to watch all that stuff. We're going to watch market rates. We're going to watch the Fed. And we have some huge data coming out this week. Earnings season basically ended today with NVIDIA, who crushed it, of course. I actually got off my last scheduled call of the day, our risk management committee meeting we have every 5 or 6 weeks. And I caught the last hour as I was driving in and doing some other stuff to hear Jensen Huang talk about AI, agentic AI, physical AI. Like, yeah, DeepSeek came out, but that's large language model stuff. That's like chatbot Q&A stuff. What about teaching a robot physical presence, how to pick up my phone and how not to like smash my nose in with its hand, or not that it's already been broken enough in my lifetime. But this stuff is ramping up, and these new chips are on full display. So the Blackwell chip is out, and there's this other chip that's coming in the second half of the year. It was really nice to be reassured. 75% of the S&P beat earnings estimates by a margin of 17%. Businesses are doing great, and AI is going to continue to bring efficiency and profitability to those businesses and our businesses. And of course, we've got great demographics. You know, I can get into immigration. One of the things I like about immigration is that we bring more workers here. A lot of jobs go to immigrants, and that keeps the money wheel turning. And so if we're going to slow down immigration, what will the lag effect of that be if, you know, yes, I understand there are costs for illegal immigrants that don't get recouped, and maybe there's not as much of a tax revenue that comes from that cohort. But, you know, if there's less jobs and less people to come in and take jobs and our demographics start to fall, remember, you know, Ivy Zellman put out a great piece a few years ago from Cradle to Grave. Our birth rate is not keeping up with our death rate. And, you know, I got 4 kids, I'm doing my part. But if we don't bring and offset that low birth rate, then, you know, we don't have the demographic workforce. Look at China, look at Japan. They are going through population decline, and it's bad news. So we're going to keep an eye on all that. But yeah, the stock market's doing great. Not a financial advisor, not responsible for your losses, only your profits. 21 asset classes, all 21 asset classes are up year to date. But you know what's interesting is a year ago when the stock market was going up, 49% of Americans had no idea. They had no idea the stock market's going up. And it's a great way to make wealth. I encourage you to download Interactive Broker and start paper trading and just kind of playing all the games, make all the mistakes without actually costing yourself money. It's a great way to understand business and how the flow of money works and help us in our own lives and business. And then, of course, generate multi-generational wealth for all of us. We talk about, you know, the bottom 90% having savings and running up their credit card debt and even defaulting on credit card debt. Affirm is a company that had a blowout earnings quarter. They do buy now, pay later, which is different than credit cards. So buy now, pay later is amazing. Chris Bixby, who is one of our managing directors at Rice Park Capital, which you guys know, I'm on their strategic advisory board and also limited partner. He used to work at a buy now, pay later company. And it's amazing to hear the mechanics of that business. It's better than a credit card because when you buy something in a credit card, you don't pay it off. The interest compounds what you owe over time. Buy now, pay later, you kind of have a fixed payment. I'm going to buy this and I'm going to pay it off in certain installments, but you don't rack up more debt because you haven't paid it off yet. Over $6 billion in the quarter in sales by Affirm. So people are trading down to buy now, pay later instead of credit cards. People are trading down to Walmart, although Walmart's guidance last week in their current earnings report was a little, you know, timid going forward. So people will trade down from Whole Foods or Ralph's or Bonds or whatever is in your market. I live in California. There are all these new places here. But Walmart's a big grocer. Over half their revenue comes from groceries. And so we're going to watch these signs as these things slow down. And that anchor is likely to keep dropping. And maybe it may stop. It might pull back up. I hit a rock or something or whatever. Or we're dragging along the floor and the floor is going deeper. So I could take that analogy anywhere. But have a great week. I'll do another video Friday after the PCE. Cheers.
You've been listening to KP Talks Dollars and Cents, a top-rated show for those who want to learn about the economy and mortgage environment. Tune in each week for more episodes, and please leave us a 5-star review on Apple Podcasts and Spotify. Kevin Perenio does not render or offer to render personalized investment or tax advice through KP Talks Dollars and Cents. The information provided is for informational purposes only and does not constitute financial, tax, investment, or legal advice. For more info, follow KP Talks Dollars and Cents on all of our social channels.